Hi everyone and welcome to this YouTube channel. In this video, we are going to talk about the new college grads on how to invest in social media. So before starting this video, please like this video and subscribe to our channel for future updates. 1. Decide how much money you have to invest. If you don't already have a system in place for tracking your expenses, it's important to set up a budget. Figure out how much money you make after taxes, and how much money you have left after paying for basic expenses such as rent, utilities, phone, cable, food, etc. Figure out how much you like to spend on things like going out, clothes or entertainment. Then, from what's left, set aside a portion for savings. Sun recommends prioritizing your emergency fund, which should include around 6 months of living expenses. Once you have a cushion in place, you can take some of your savings and start investing it. One thing you have to decide is how much risk you are willing to take. There are some investments that could make you a lot of money, but you could also lose a lot of money. You may say, yes, I'm comfortable with risk. Let's go aggressive, Sun explained. But, if that aggressive decision means your $1,000 portfolio could drop to $400, how do you feel about that? Now, to be clear, in that scenario, you never actually lose that $600 unless you cash out. If you don't need that money, you should never be investing money you need for bills or other expenses. Then you can let it ride and see if it bounces back. But, if all of that makes you a little queasy, either 1. Don't invest a lot in a risky investment, or 2. Stick with less risky investments. 2. Where to start investing? The first step. What type of account are you going to put your money in? A brokerage account is a taxable account that allows you to buy and sell stocks, ETFs, bonds, mutual funds and other types of investments without a fear of penalty. Many brokers today offer low minimum deposits to get started. Investors utilize brokerage accounts for day trading and long-term investing and to save for short-term financial goals. When it comes to getting started, you don't have to do it alone because there are plenty of apps out there to help guide you in this journey, including Acorns, Betterment, Fidelity, Sophie, Robinhood and TD Ameritrade. Some allow you to make individual trades in stocks, bonds and mutual funds, and others have you choose your risk level. And then it automatically invests your money in mutual funds that match that. So, do some research. Choose one. If you feel like it isn't working for you or you re-curious, try another one until you find what's right for you. There's no one right or wrong way to invest. 3. Know your investment options. We've thrown around a lot of terms: stocks, bonds, mutual funds, etc. So, let's go over some definitions for common ways to invest. Savings account. A savings account is the most basic financial investment, which allows you to store money securely while earning interest. The annual percentage yield, or the real rate of return earned on an investment, reaches 0.50% on some accounts. A savings account allows for you to differentiate your everyday spending money kept in a checking account from money that is meant to be used at a later date. This type of account is federally insured up to $250,000, so you won't lose your money if the bank fails. You would typically do this at a bank. Could be the same bank you have your checking account with, but some people prefer to put their savings at a different bank. Choosing a different bank might make sense for you because you can shop around for the best rates. Certificates of deposit, CDs. This type of account is similar to a savings account but with a fixed time period and a higher fixed interest rate, more money. So, the catch is that it locks you in for a certain time period where you can't touch that money or else you will face a penalty, fee. So, it's a great way to make more money than a typical savings account, but you want to make sure it's money you won't need for anything so that you can drop it there until the time period, 2 years, 3 years, whatever, is up. Money market funds. Money market funds generate income that are considered extremely low risk, which means they also don't generate a high rate of return. But they are a safe option, letting your money grow little by little. So, financial advisors will often recommend keeping a certain amount of your portfolio in a money market fund for security but not too much. If you know you have $500 to invest, maybe you park it there first, then start moving it into other investment options. Stocks. When you buy a stock, you are essentially purchasing one piece of one company. The shareholder is entitled to own portions of the corporation's assets and profits depending on how much of the stock they own. Most stocks are bought and sold on exchanges such as the Nasdaq or the New York Stock Exchange. But you can purchase them through an app or a broker. Bonds. In the simplest terms, a bond is a loan from an investor to a borrower such as a certain company. The company uses the money you lent it to fund its necessities. Meanwhile, the investor receives interest on the investment. Bonds are a key ingredient to having a balanced portfolio as it can help soften the blow if the stock markets plummet. Mutual funds. Mutual funds bring together investments from many people and invest that money in stocks, bonds, and other assets. The specific stocks, bonds, and assets the money is invested in are known as the portfolio. The criteria for what goes in the portfolio can be anything from a sector, such as technology or healthcare, to a risk level, growth versus value, or a target date, such as 2030. Mutual funds are managed by a money manager who selects and changes the assets in the portfolio to try to maximize profits for their investors. Since there is an expert involved in managing the investments, there are fees involved. Exchange-traded fund. ETFs are similar to mutual funds in that they are a collection of assets, but they are designed to track a particular index, sector, commodity, or other asset. So, you might have an ETF that tracks corporate bonds or real estate. Bombardier recommends students invest in low-cost, well-diversified ETFs as it allows them to have access to hundreds of stocks, without having to personally research each one of them. 4. Index funds. An index fund is also a collection of assets, but they are pegged to a specific index such as the S&P 500 or Nasdaq. One of the perks of index funds is that they tend to be lower in cost because they don't have an expert taking the time to pick stocks or bonds for funds. Hahn recommends students invest in index funds because you put some money in it, can set up automatic recurring purchases and have dividends automatically reinvested on their own. The key is to diversify. The key, experts say, is to diversify, which means have a variety of investments in different things. Don't put all of your eggs in one basket. That keeps balance, and if one investment is going down, another might be holding steady or going up. For example, if your investments are all in tech and all of a sudden the tech sector starts sliding, so is your portfolio, Sun explained. If you have some in tech, maybe some in healthcare and those more traditional companies that pay dividends, Sun said, then your overall portfolio is a little bit better balanced. So, try to make sure you have investments across a wide variety of sectors, such as technology, healthcare, retail, financial, etc., as well as risk levels. Growth stocks, for example, can gain a lot but also lose a lot. Value stocks are more steady growth. You can also invest in currencies, commodities, and riskier investments such as cryptocurrencies and NFTs. Those tend to be more volatile and complex, so you really want to do your homework, and make sure you are only investing what you can afford to lose. It's okay to get advice from friends when investing, but you need to do your own research and you need to be diversified. If your friend says buy XYZ stock because it went up for them, don't just buy that and leave it at that. It could go down for you. So, if you're diversified, you have a cushion for that. 5. Do your homework. Understand the risks. Risk is an important factor to note when you're choosing what to invest in. Low-risk investments such as savings accounts or certificates of deposit see smaller gains and smaller losses. Other investments such as high-growth stocks or Bitcoin can make you a lot of money quickly, but they can also lose you money just as quickly. It's not to say you shouldn't make risky investments, just know how much money you have to gamble with on these more volatile investments and keep some of your money on more steady investments. Money is tied with hopes and dreams and people just want the benefits but don't understand the risks, cautioned Rose Hahn, a former Wall Street trader and financial educator. If you don't understand what you invested in, why you invested in it, and how long you should be holding that investment for, then you might sell because the value went down a bit and you got scared. But in the meantime your investment balance might suffer. It can be easy to get caught up in the moment, but it is vital that students not let their emotions cloud their decision-making. Tobias Edwards, a senior at the University of Missouri-Columbia studying communications with a minor in personal finance planning, started investing after high school in 2018. He bought a course on Instagram and was able to educate himself through that platform. Through Edwards' investing journey, he said one of his big mistakes was not accepting he lost money and not having the knowledge of how the market works. Now I really understand the natural things of a market going through ups and downs. I don't really try to stress too much if I'm down too much in that position but rather just try to find the middle ground, adding that investing actually helped him understand emotional intelligence better. Thanks for watching.